Bitcoin hit $73,000 today, March 13th, 2026. The same asset that every financial headline on earth declared dead 6 weeks ago. That sentence would have been received as delusional optimism in February, when BTC was collapsing towards $60,000, when Google searches for "Is Bitcoin dead?" hit their highest levels since 2022, when the Bitcoin bear market was being declared permanent by the same financial press that missed the entire Bitcoin bull run from $40,000 to $126,000. They were wrong about $60,000 being the Bitcoin bottom. They were wrong about the Bitcoin bear market having another 12 months to run. They were wrong about Bitcoin being a risk asset that only goes down when oil goes up. And today, on March 13th, Bitcoin hit $73,000, the only major asset class in the world showing positive returns since the Iran war began. While gold is down, stocks are down, and oil is at $100 per barrel. The question is not whether the people who declared Bitcoin dead in February were wrong again. The question is why they were wrong. What four structural forces drove the Bitcoin crash? What the Bitcoin on-chain data and Bitcoin ETF flows were showing while the headlines were screaming Bitcoin drawdown? And what the Bitcoin price analysis actually looks like when you examine the data instead of the narrative. That is what this video is about. Not a Bitcoin price prediction, not number go up. The specific, verified, sourced answer to the question every Bitcoin holder, every BTC investor, every institutional investor watching this is asking right now, is it too late to buy Bitcoin in 2026? Or did the $60,000 Bitcoin bottom just create the best institutional Bitcoin buying opportunity since the post-FTX bottom of 2022? There are four causes behind the Bitcoin crash. Each one made the next one worse. And there are four data points behind the Bitcoin recovery that the mainstream financial press is not connecting clearly. We are going to examine all 8. Let us begin. Before we go further, the essential disclaimer. Nothing in this video is financial advice. Bitcoin and BTC are among the most volatile assets on Earth. Bitcoin crashed 52% from its all-time high between October 2025 and February 2026, a drawdown that wiped out over a year of gains in 4 months. It can crash again. Consult a qualified financial advisor before making any Bitcoin investment decisions. The first cause of the Bitcoin crash was the Bitcoin death cross of November 16, 2025. 6 weeks after Bitcoin hit its all-time high of $126,000, the 50-day moving average crossed below the 200-day moving average on the BTC price chart. In technical analysis, this is a Bitcoin death cross. And every Bitcoin holder who has lived through a bear market knows what that moving average signal means. Bitcoin was trading near $93,000 when the death cross confirmed. CoinDesk documented the crossover precisely. The 50-day moving average at $110,669 crossed below the 200-day moving average at $110,459. 3 previous Bitcoin death crosses in this BTC cycle, September 2023, August 2024, April 2025, had each marked a local Bitcoin bottom and preceded a Bitcoin rally back to new highs. Institutional investors and retail Bitcoin holders who used the buy the dip strategy at each death cross made money every time. The moving average crossover had been a reliable Bitcoin price prediction tool in this cycle. This death cross was different. This time the Bitcoin death cross arrived during simultaneous institutional Bitcoin outflows, a hawkish Federal Reserve, and a macro backdrop that was the opposite of the liquidity environment that powered previous Bitcoin recoveries. The death cross was not the cause of the Bitcoin crash. It was the first warning that a Bitcoin bear market of unusual severity was coming, and that the Bitcoin drawdown would be deeper than the institutional investors who bought the dip at $80,000 expected. The second cause was the Bitcoin ETF outflow cascade, the cause that almost no Bitcoin price analysis in 2026 is explaining correctly. Spot Bitcoin ETFs, the institutional products that drove BTC from $40,000 to the Bitcoin all-time high of $126,000, saw nearly $6 billion in net outflows between November 2025 and January 2026, according to CoinDesk and Investing.com data. In the single week ending January 23, 2026, $1.33 billion exited Bitcoin ETFs in 7 days, the largest weekly Bitcoin ETF outflow since spot Bitcoin ETF funds launched in January 2024. BlackRock Bitcoin IBIT, the largest spot Bitcoin ETF in the world, saw $1.26 billion in net outflows in a single day in November alone. That was the second largest single-day withdrawal in the Bitcoin ETF fund's history. Meanwhile, as institutional investors were selling BTC, gold ETFs were absorbing $16 billion in fresh inflows over the same period. The Bitcoin versus gold rotation was the most visible institutional Bitcoin trade of early 2026, and it was the clearest signal of where institutional investors thought the Bitcoin store of value narrative stood versus the gold store of value narrative at that specific moment. The institutional investors that had been the Bitcoin demand floor had become sellers. Without that Bitcoin ETF demand floor, every Bitcoin support level retail traders trusted became a Bitcoin drawdown trap. Bitcoin holders who used the buy the dip strategy at $80,000 watched BTC fall to $70,000. Holders who used the buy the dip strategy at $70,000 watched BTC fall to $60,000. The Bitcoin 4-year cycle bear market had found its mechanism. Should I buy Bitcoin at $80,000 was the wrong question.
Hello guys, are you enjoying John's analysis? Let us know in the comments.
The Bitcoin price target was lower. Is it too late to buy Bitcoin was not the right question yet. The Bitcoin bottom had not arrived. The third cause was a hidden hedge fund blowup that nobody in the Bitcoin market saw coming. On February 5th, 2026, the BTC price collapsed nearly 30% in a single week, from approximately $90,000 to $60,000. The speed of this Bitcoin crash produced the largest single-week Bitcoin drawdown since the FTX collapse of 2022. The theory that gained traction, documented by CoinDesk and Ainvest, pointed to Hong Kong-based hedge funds that had built leveraged call option positions on BlackRock Bitcoin IBIT using yen carry trades, borrowing cheap Japanese yen to fund high-yield institutional Bitcoin positions. When the Bank of Japan signaled rate hikes, the cost of those yen carry trades increased sharply, forcing immediate Bitcoin liquidation. The result was forced BTC liquidation executed entirely through Bitcoin ETF mechanisms rather than crypto-native channels. IBIT posted its single largest ever volume day at $10.7 billion on February 5th, alongside a record $900 million in options premium, a pattern consistent with massive institutional Bitcoin liquidation, not typical retail Bitcoin selling. Parker White, COO and CIO at DeFi Development Corp., identified this pattern in the IBIT data directly. Glassnode documented that Bitcoin realized losses hit an 18-month high. Total Bitcoin and crypto liquidations reached $2.5 billion, confirmed by Encrypted. Bitcoin exchange reserves spiked as forced sellers moved BTC onto platforms. Bitcoin whale wallets that had been accumulating for months were being forcibly unwound by leveraged institutional investors. Michael Saylor's strategy, the largest corporate Bitcoin treasury in the world, holding 713,502 BTC at an average cost of $76,052, was sitting on $6.5 billion in unrealized Bitcoin losses and was publicly stress testing an 88% Bitcoin crash scenario. The fourth cause was psychological, the cause that matters most for understanding the Bitcoin recovery data. Bitcoin entered February 2026 on track for something that had never happened in its 17-year history, back-to-back monthly Bitcoin losses to open a calendar year. January was down 10.17%. February was down 12.12%. The Bitcoin fear and greed index dropped to single digits. The Bitcoin fear and greed reading was at levels not seen since the FTX collapse of 2022. Google searches for "Is Bitcoin dead?" and "Is Bitcoin worth anything?" reached multi-year highs. The question, "Should I buy Bitcoin now?" was being answered with one word: wait. The Bitcoin investment narrative had not just weakened, it had collapsed. Is it too late to buy Bitcoin was being asked by millions, and the answer being given was that Bitcoin worth investing in had become Bitcoin worth avoiding. The consensus was that the Bitcoin 4-year cycle bear market had another 12 to 18 months to run. This is the critical context for understanding the Bitcoin halving cycle. The Bitcoin halving of April 2024 cut the BTC block reward from 6.25 Bitcoin to 3.125 Bitcoin, reducing new Bitcoin supply by 50%. Post-halving, the Bitcoin price historically peaks between 12 and 18 months after the event. The Bitcoin all-time high of $126,000 arrived exactly 18 months post-halving, on schedule with the historical BTC cycle pattern. The Bitcoin 4-year cycle bear market that followed every previous post-halving Bitcoin rally lasted between 12 and 18 months before the next Bitcoin bull run began. The Bitcoin price target of $50,000 being called by analysts was not irrational. It was the Bitcoin halving cycle data projected forward. The Bitcoin cycle bottom, on historical precedent, lands somewhere between October 2026 and April 2027. That Bitcoin price prediction had legitimate data behind it, and here is what actually happened instead. Right here, right now. Before the Bitcoin recovery data, I want to stop and say something directly to you, and I mean every word of this. Most people who clicked on this video left within the first 3 minutes. They saw Bitcoin crash in the thumbnail, decided they already knew the ending, and left. You did not leave. You stayed through the Bitcoin death cross mechanics and the moving average data. You stayed through the Bitcoin ETF outflow cascade. You stayed through the Hong Kong hedge fund blowup. You stayed through Michael Saylor, the most convicted corporate Bitcoin treasury holder on earth, stress testing an 88% Bitcoin drawdown scenario with over 700,000 BTC on the line. That is not casual Bitcoin interest. That is the behavior of someone who actually wants to understand what is happening to Bitcoin, not just hear a number and react to it. The Bitcoin investors who make the right calls at turning points are not the ones who react to price. They are the ones who understood the structure before the price moved. Drop a comment right now with 3 things: your city, what the weather is like, where you are, and what time it is as you watch this. I read every comment. Understanding where this Bitcoin community is and when this analysis is landing is how I build content that is actually useful. Hit, like while you were down there. Now, here is what the Bitcoin on-chain data and Bitcoin ETF flow data actually showed while retail was screaming that BTC was dead. The Bitcoin recovery began not with the Iran war. It began 3 weeks earlier with silent institutional Bitcoin accumulation, while retail Bitcoin sentiment was at maximum negative. Between February 24th and March 5th, 2026, BlackRock Bitcoin IBIT accumulated a net 21,814 BTC, approximately $1.55 billion at current Bitcoin prices, confirmed by investing.com and blockchain.news. This was not retail Bitcoin buying. This was not a Bitcoin rally driven by speculation. This was the world's largest asset manager, $14 trillion under management, identifying the $60,000 Bitcoin bottom as a strategic institutional Bitcoin accumulation zone, and executing. On March 4th alone, BlackRock Bitcoin IBIT absorbed $306.6 million in a single session, approximately 66% of the entire day's spot Bitcoin ETF inflows across all issuers. Institutional investors were buying the Bitcoin dip, while retail was searching, is Bitcoin dead? Robert Mitchnick, head of digital assets at BlackRock, stated directly on CNBC that 90% of IBIT's investor base are long-term Bitcoin holders who had been accumulating BTC throughout the Bitcoin bear market, the HODL strategy in its purest institutional form. 90%. The HODL strategy. During the deepest Bitcoin drawdown of 2026. These are not Bitcoin whales who panic sell at the first sign of a Bitcoin correction. These are institutional investors with a Bitcoin price target measured in years, not weeks. Long-term holders who HODL through Bitcoin bear markets are the demand foundation that makes every Bitcoin bull run possible. Strategy, the largest corporate Bitcoin treasury in the world, did not sell a single BTC during the Bitcoin crash. Instead, Michael Saylor's company purchased 17,994 Bitcoin between March 2nd and March 8th at an average BTC price of $70,946, confirmed by Fortune, Cointelegraph, and The Block, bringing total strategy Bitcoin treasury holdings to 738,731 BTC. The largest corporate Bitcoin buyer in history bought the Bitcoin bottom. Aggressively. Strategy. Bitcoin accumulation during a Bitcoin bear market is the most important institutional Bitcoin signal of 2026. Morgan Stanley filed with the SEC for its own spot Bitcoin ETF during the same period, naming Coinbase and BNY Mellon as custodian partners. Morgan Stanley's institutional Bitcoin ETF filing during a Bitcoin bear market is not the behavior of institutional investors who believe BTC is finished. It is the behavior of institutional investors positioning for the next Bitcoin bull run before retail Bitcoin holders return to the Bitcoin market. The Glassnode Bitcoin on-chain data confirmed what the Bitcoin ETF flows were showing. Bitcoin long-term holders, BTC wallets holding Bitcoin for more than 155 days, reached their highest Bitcoin accumulation levels in 2 years during February, even as the Bitcoin price was hitting its lows. Long-term holders were not selling. Long-term holders were accumulating. Bitcoin whale wallets were not selling. Bitcoin whales were accumulating. Bitcoin exchange reserves were falling as long-term holders and Bitcoin whale wallets moved BTC into cold storage, the on-chain show deal behavior that precedes every Bitcoin bull run in history. The Glassnode Bitcoin on-chain data and the Bitcoin ETF data were telling the same story simultaneously. Institutional investors, Bitcoin whale wallets, long-term holders, and corporate Bitcoin treasury holders were accumulating Bitcoin at $60,000, while retail Bitcoin sentiment was screaming that Bitcoin was dead and Bitcoin 2026 was a disaster. The Bitcoin supply held by long-term holders reached a 2-year high. Bitcoin supply on exchanges was falling. The Bitcoin fear and greed reading was at extreme fear, and smart money was buying. Then the Iran war started on February 28th, and the Bitcoin price did something that changed the Bitcoin versus gold debate permanently. Oil went to $100 per barrel. Stock markets dropped. The S&P 500 fell between 1 and 2%. Gold, the 5,000-year Bitcoin versus gold safe haven competitor, surged initially, then gave back its gains. By March 13th, gold was down 3% from pre-conflict levels. Silver was down more than 10%. Bitcoin hit $73,000 today, an 8% Bitcoin rally from pre-conflict levels. BTC is the only major asset class in positive territory since the war began. The Bitcoin versus gold comparison during this conflict is the most analytically important Bitcoin price data point of 2026, because it happened during an active oil shock, with oil at $100, in the exact environment where the Bitcoin safe haven and Bitcoin inflation hedge narratives needed to produce real results or be dismissed as theory. Bitcoin versus gold. Bitcoin up 8%, gold down 3%, over 2 weeks of active military conflict with oil at triple digits. Bitcoin safe haven performance finally matched the Bitcoin price prediction that Bitcoin bulls had been making for a decade. Bitcoin's correlation with gold flipped from negative 49% to positive 16% during the conflict, documented by Brian Tan at Wintermute. For the first time in a live geopolitical crisis, Bitcoin was trading like a macro hedge and Bitcoin inflation hedge asset rather than a leveraged tech proxy. The Bitcoin inflation hedge thesis, that Bitcoin's fixed supply of 21 million BTC coins makes it structurally attractive in inflationary environments driven by money printing, produced measurable Bitcoin price data in real market conditions during an active oil shock. The Bitcoin fear and greed index began recovering as institutional Bitcoin demand absorbed every dip. Oil at $100 is an inflation event. Bitcoin going up while oil goes up is the Bitcoin inflation hedge thesis in live price action. Not in a Bitcoin price prediction model, in the Bitcoin market during a war, with petrodollar stress visible in real time. The petrodollar system, the arrangement that sustains dollar reserve currency status by guaranteeing safe international shipping lanes in exchange for oil priced in dollars, was showing fractures. In Bitcoin's fixed supply of 21 million coins, the digital gold store of value that requires no petrodollar guarantee to function hit $73,000 today on March 13th. Here's the honest Bitcoin price analysis as of March 13th, 2026. The Bitcoin all-time high remains $126,000, reached October 6th, 2025. Bitcoin hit $73,000 today, still approximately 42% below its Bitcoin all-time high. The Bitcoin death cross technically remains in effect. The Bitcoin drawdown from peak is still severe. Any Bitcoin price prediction declaring the Bitcoin bear market definitively over is not Bitcoin price analysis. It is hope dressed as data. Is it too late to buy Bitcoin today? Is the Bitcoin bottom confirmed at $60,000? The Bitcoin fear and greed index remains in fear territory, and 43% of Bitcoin holders are still underwater from the drawdown, representing potential selling pressure on any sustained Bitcoin rally. The Bitcoin bear case for 2026: if Iran war de-escalation removes the Bitcoin safe haven tailwind and institutional investors reverse Bitcoin ETF inflows, the BTC price faces a drawdown back to the $62,000 to $65,000 range. The Bitcoin 4-year cycle bear case projects a further 30% Bitcoin price decline. A Bitcoin price revisit of $50,000 by mid-2026 is a real scenario. The Bitcoin correction to $50,000 remains a real downside scenario. The Bitcoin cycle bottom may not be confirmed yet. Bitcoin worth holding long-term is not Bitcoin worth buying with money you cannot afford to lose. The Bitcoin bull case for 2026, the $60,000 Bitcoin bottom, absorbed $2.5 billion in forced Bitcoin liquidations and held as support. Institutional investors at BlackRock Bitcoin accumulated $1.55 billion in BTC at the Bitcoin bottom. Strategy, Bitcoin Treasury, bought the Bitcoin bottom with $1.28 billion. Bitcoin whales and long-term holders documented in Glassnode Bitcoin on-chain data reached 2-year accumulation highs. Morgan Stanley made an institutional Bitcoin ETF filing. Long-term holders hodled through the entire Bitcoin drawdown. Bitcoin exchange reserves fell. Bitcoin supply available for sale is down. These are not the behaviors of a Bitcoin market that is finished in 2026. The Bitcoin halving cycle context for any honest Bitcoin price prediction. Every Bitcoin bear market following a post-halving peak has produced the next Bitcoin bull run within 18 to 24 months. If Bitcoin's 18-month post-peak recovery timeline holds, the next Bitcoin bull run begins between April and October 2027. Arthur Hayes of Maelstrom argued directly that the Iran war makes Federal Reserve money printing and rate cuts more likely. the exact Bitcoin money printing cycle environment that drove BTC from $3,000 to $68,000 between 2018 and 2021. War spending requires monetary expansion. Monetary expansion in a fixed supply Bitcoin environment flows toward that fixed supply. 21 million Bitcoin, not one coin more. The Bitcoin versus gold question in a war spending money printing environment resolves in Bitcoin's favor. Bitcoin's fixed supply of 21 million coins, the 21 million BTC hard cap that no government, no institutional investors, no central bank can change, makes it structurally more attractive than digital gold as a store of value when petrodollar stress is accelerating and money printing is funding military spending. Gold mining expands in response to price signals. Bitcoin supply does not. That is the core of the Bitcoin digital gold investment thesis. The Bitcoin investors who understand what happens to the BTC price next in 2026 are not the ones who panic sold during the Bitcoin drawdown to $60,000. They are the ones who tracked the Glassnode Bitcoin on-chain data, watched the Bitcoin ETF flow reversals, noticed Bitcoin whales and institutional investors accumulating at the Bitcoin bottom while retail Bitcoin sentiment was at its worst, and asked the question almost nobody was asking in February. If this is a Bitcoin bear market with no floor, why are Bitcoin whale wallets accumulating? Why are institutional investors at BlackRock buying $1.5 billion of BTC at the Bitcoin bottom? Why are long-term holders hodling through a $60,000 Bitcoin price? And why is Morgan Stanley making an institutional Bitcoin ETF filing during a Bitcoin bear market? Is it too late to buy Bitcoin in 2026? Is the BTC price going to recover? Is this the start of the next Bitcoin bull run or another Bitcoin bear market trap? The Bitcoin on-chain data, Bitcoin ETF flows, corporate Bitcoin treasury activity, Bitcoin versus gold performance, and Bitcoin inflation hedge correlation data all point toward the same Bitcoin price analysis. The Bitcoin investment case today at $73,000 is stronger than it was at $60,000 6 weeks ago, when every headline said BTC was dead and every Google search asked, is Bitcoin worth anything? The Bitcoin bottom may be in. Bitcoin hit $73,000 today on March 13th. The Bitcoin price target of $100,000 may be back on the table. The next Bitcoin bull run in 2026 or 2027 may already be starting. Or the Bitcoin 4-year cycle bear market has more drawdown ahead. The Bitcoin correction to $50,000 may still come. The Bitcoin halving cycle bottom may land in 2027. Both scenarios are real. The Bitcoin market data you now have is the best available tool for deciding which one you believe, and acting before the Bitcoin price makes the decision for you. Drop your city, weather, and time in the comments. And share this Bitcoin price analysis with one person who either panic sold BTC during the February drawdown or is still waiting for Bitcoin to go to zero before they pay attention to the data. Someone in your circle made a Bitcoin investment decision based on narrative instead of Bitcoin market data in 2026. They deserve this analysis. Thank you for your focus. I will see you in the next one.